Welcome back for the last time. So how many of you are graduating at the end of this class? I hold the power over you. No, I'm not going to use it. Just forget to turn your grades in. That'd be so petty, wouldn't it? No. But anyway, just a reminder that your final exam is day after tomorrow. So it's from 1:30. I'm sorry, what? Your graduation can be optional, but the final is not. So if you had to pick one to be optional, that would be it. Right? So, but it's going to be 1:30 to 3:30. It covers everything in the class. So there's a lot of stuff. My advice is you work with if you're going to try the past final, start with the most recent one, work backwards. Right? Because the finals have evolved over time. They've changed the structure. I've changed the structure a little bit to make it less. I mean, I give fewer multi-part questions than I used to because it's a nightmare grading multi-part questions because you get part A wrong, then I got to keep track of what you got. This way, it's all about me anyway. So I just made it easier to grade. So it's 9 questions. So it's very much like the past exams. So today's session, I'm going to do a review of the class using the numbers you turned in as my vehicle to look at the class. Right? So let's think about it, right? You start the class, I said there were 3 ways you could put a number on an asset. And this isn't exactly the way I described at the start of the class, but now that you've gone through the process, I think this might be a better way to describe it. Discounted cash flow valuation, where you try sometimes desperately to make up a story and come up with inputs and estimate an intrinsic value for the company. Or pricing, where you try to find other companies that you claim are just like yours and you come up with a multiple. You try 3 until you find one that works and say, this is the pricing for the company. Or option pricing in your companies, where you basically are stealing from the bondholders to make your equity investors look like they're worth some money. So let's go back and kind of do a very quick review of intrinsic valuation. And we have discounted cash flow model. There's an equation, expected cash flows, discount rate. It's a very simple equation. But if you break it down, there are 4 components that drive value. The first is the value of existing cash flows. That's your starting point coming from your financials. That's the easiest question of the 4 to answer. The second is the value of growth, which can be positive, negative, or neutral. And if you take nothing else out of this class, if that is what you take out, growth can be good, bad, or neutral, depending on how much you reinvest to get it. So when you look at the cash flows, each item there carries a weight, right? The starting point gives you a sense of what the existing assets deliver. Growth shows up in 2 places. The good is the growth rate you put in, the 20, 30, 40% growth rate. The bad is the reinvestment that comes with that growth. The net effect is what drives that. There's only one place in the DCF where risk shows up, in your discount rate. And we can do the dances that you want about diversified, undiversified investors, but ultimately shows up as a cost of equity and a cost of debt, which gets incorporated into cost of capital. And in every discounted cash flow valuation, you're constantly looking for closure. Closure in the sense you can't estimate cash flows forever. You can't even estimate cash flows for 20 years. At some point you stop and say, can I stop now? And if it's a true intrinsic valuation, the place you stop is when you feel your growth rate is hitting the growth rate of the economy. That's what gives you the terminal value. And incidentally, it doesn't have to be forever. It could be for the next 50 years, but something to put closure. And of course, this then boils down into the very simplistic model that you see driving the simple Ginzu model. But to get the cash flows, I ask you for 3 numbers. And the 3 numbers, in a sense, encapsulate what you think about your business model. How much can your revenues grow? That's a growth part of your business, and that can be high, low, or even negative. How well will your profitability hold up? You capture in the margin number, which reflects the unit economics and the economies of scale you see in this business. And how much will you have to reinvest to get that growth, with the sales to capital ratio becoming the linking. And to get the risk in, you have a cost of equity and a cost of debt, but ultimately the cost of capital reflects the operating risk of your company. That's what cost of capital is designed to do. And it'll tell you as a going concern how much risk there is in the company, which leaves you with one final input, the failure risk that allows you to bring in the fact that you might not make it as a going concern. Now, as you've gone through this class, you notice that I keep going back to this no matter how complex a company is, because it allows me then to frame my story in a way that I can capture it in those inputs. Now, remember midway through the semester, I asked you for your DCFs and, you sent them in, I gave you feedback. As you notice, the feedback was not about your growth rate being right or wrong, it's about internal consistency. I was checking to see, is your story at war with itself? And here's what I mean by that. If you take a story, it's got three dimensions to it. There's a growth part, there's a profitability part, and the risk part. Usually, if you have a high growth company, it will tend to be high risk and require high reinvestment. Usually, if you have a low growth company, you'll have low risk and low reinvestment. Can you have a mismatch? Yes, but that's where your story has to come in. So if you give me a story of a company with high growth, low reinvestment, and low risk, then you got to fill in the blanks and say, this is why this company can pull off this unusual combination. So as you look at DCFs in the future, especially if you're looking at other people's DCFs, focus in on those three components. So growth is going to, of course, show up in the top line. The reinvestment is going to be what separates your earnings from your cash flows. That's the difference. And your risk is going to show up in your discount rate. Are the three numbers internally consistent? And is the story at war with itself? So let's look at your numbers. There were 127 people in this class, I think. Most valued company is NVIDIA. Why? Because it's in the news, right? That already tells you when you pick companies, you will tend to go with winners and because that's what you're interested in. Nobody wants to look at the loser companies. Lululemon, I said this in my corporate finance class, I don't know what it is about that company. I despise that company at this point in time. I've probably seen 100 valuations of Lululemon by now. Yeah. So there's something about this company that's all. Novo Nordisk and Nike were valued by, and there were 5 other companies where you had at least 2 people valuing the company. And I remember early in the semester, somebody asked me, why don't you restrict, and my response is, what difference does it make if 5 people value the company? In fact, here are the 5 NVIDIA valuations. I left the caps, I didn't touch them. Maybe you were trying to yell the company's name at me or whatever it is, or maybe just caps were on. No. So the hold there might be a strong hold for all I know. No. But if you look at the NVIDIA, basically there's a data valuation. The prices, even though are varying because, it's over the week people did this, different multiples. But you can see that there isn't a single number here that is exactly the same, the DCF value, the price. You and I can pick the same company, but we're going to arrive at very different destinations. Why? Because the story and the numbers we use will be different. We could all have done the same company. And to the extent that we bring different stories in, you're going to get different numbers. The divergences are going to be greater if you have a young company. If we'd all value Tesla, we're going to get a much more divergent set of numbers than if you value Coca-Cola, because stories start to converge as companies mature. And here's what you found. On average, so forget the average. The average is going to get put. Let's focus on the median. The median company was overvalued by about 28%. That's a pretty high overvaluation if I look across time. So clearly you found more companies overvalued than undervalued. About 65% of your companies were overvalued. About 35% were undervalued. So with that lead in, let's look at the cheapest companies according to you. I'm going to constantly pass the buck back to you. So if you buy these stocks, it's basically it's not my fault. I'm just the conveyor of the numbers. So it's, think of this as the disclaimer that I'm putting out there. These are the numbers you gave me on the spreadsheet. I didn't touch a single number, even when it looks strange. And some of them look strange to me, so I just left them as is. So these are the most undervalued companies. The way I'm measuring undervaluation is I'm looking at your DCF value relative to the price per share. So, and you can go down the list. If anybody is, the reason I keep these lists is I will invest in one of these companies, but only if you're buying too. So no, I don't have the money now. I could buy, I might buy, you either buy or not. So I'm going to send an email to the people who value these companies. Are you buying? And you better not be lying, right? Because every semester that I've taught this class, I buy one stock off this list. And I'll show you what that stock has done historically. No, but this is my saying, I teach the class, I might as well put my money behind the valuations that come out of the class. Okay. So I'm sure, but if you look at the recommendations, there are a few of the most undervalued stocks where you see a sell or a hold, which suggests to me that, you think they're undervalued, but you have enough reservation based on the pricing that you're holding back, or you're weighting the pricing more than the intrinsic valuation. And I left that choice to you. And part of the reason I left it to you is, if you ask me which is better, there is really no answer, right? It depends on your time horizon, depends on how comfortable you felt with your intrinsic valuation. So it's not unanimous buys across the board. So if you're one of those 10 and you're buying, or maybe I should turn back, rather than emailing you and putting you on the spot, if you're buying, if you're on that list, you buying Reservoir?
I sold it last week.
Okay, that tells me everything I need to know. So maybe now is not the time for me to jump in, but so if you're buying, if you're on this list and you're buying, let me know. And don't make this, I bought one share. Do at least, put something in there, a segment of your cap. These were your most overvalued stocks. Okay, and you can see at the very top, you got AMC. Notice the value per share is negative. Noah and I went through this. We did this dance all semester. He tried so hard to get the equity value positive, right? And tell us why is AMC so much underwater? What is it about the company that's putting it underwater?
It loses enormous amounts of money every single year, and it has enormous amounts of debt.
It's got $9.4 billion in debt, and getting the value of a movie theater company even close to that number right now is incredible. It's got a broken business model. We're not going to movie theaters enough. And we know why, right? You got a 70-inch TV in your home. If you go to an AMC theater, one of those small theaters, that screen is about the size of what you have in your home, and you got to sit with 45 other people. So you can't do things like hang out in your underwear and watch it, the kinds of things you might do at home. So the theater business is broken. The entertainment business is broken. Streaming and technology have changed it. And right now, nobody knows whether you can fix it. So when you see that negative value, it basically doesn't mean the value, he came up with an value of the operating assets of 1.8 or 1.9 billion. But when you own 9.4 billion in debt, there is no equity value. Right? The real, that's who did the real? Real. I remember we talked about this, and when she described it, I said, I've never used this, but clearly this is out there. And can you tell the class what real? I mean, I'm sure they know, but they might be shopping there. What does real do? Secondhand luxury items, basically, which is. And the problem with secondhand luxury items is you go on Craigslist and buy a secondhand luxury item. It's probably not a luxury item. It's a Canal Street version of a luxury item. So Real brings in this mechanism, or at least a process for trying to prevent you from buying a fake Rolex or a fake, some brand. They have a niche, but what's the problem with that niche? The problem is getting, when you think about checking for authenticity, it's not like you can hire one expert who can check across. It turns out that each item requires its own expert. It's an incredibly expensive process. which means by the time you, and it's variable, right? If you keep adding items, you got to hire a new expert on that item because you can't get your Rolex expert to check out the products and say, are these bags okay? He has no idea. It's a business that doesn't scale up well. And unfortunately, even as it gets, and it's getting competition. So what AMC and Real share is their business models that are either broken or frayed, and it shows up as negative value. So equity value can be negative, especially when your business models are struggling. The other class, there's one kid, one of the undergraduates picked WeWork, and I begged him, don't pick WeWork. I mean, it's going to be so difficult to get this broken business. He chose to stay with it, and not surprisingly, he's getting a negative value for the equity as well. And so you'll notice that again, it's not unanimous, but almost every one of the overvalued you see a sell. You have a couple of holds, one with Sweet Green and the other with Estee Lauder. And there, the DCF value gives you enough feeling to kind of hold back on. Now, this class I've been teaching for 40 years, and you get these valuations, especially the intrinsic value basis. It's not fair to come back 3 months from say, has your stock made? So I've got to give them time to ripen. So in about 5 years, so in about 2029, if I'm still around, I'll check your recommendations and reach out to you on the investments. No, I won't reach out to you. No. But basically, think of this as the returns in the years after. So if you look at, so the last one I stopped here was spring of 2009. I now have the numbers. But basically, if you look collectively at the buys, the holds, and the sells, the good news is collectively there is some information there. If there were no information, you know what you'd see, right? In this graph, the buys, the sells, and the holds will all look the same. But if you dig deeper, here's what on average, across all the years I've seen. On average, about 60% of buy recommendations make money, but 45% of sell recommendations also make money. It's clearly not a perfect signal. It's a noisy signal. And if you look at at breaking it down to big companies and small companies, the buy recommendations in small companies and emerging market companies seem to have more heft on them than the buy recommendations on NVIDIA or Apple, where everybody's in the company. The differential information that you bring is relatively small with the big companies. And in every single year that I've tracked this, it's not that your portfolio, most of your stocks in your portfolio beat the market, it's you get one or two winners. And this is the nature of equities. It's something we have to remember when we walk into equities, that when you have a winning portfolio, it's not because 80% or 50% or even 60% of your portfolio beat the market. You had that one big winner. You bought Apple in 1999. You bought NVIDIA in 2018. And you had the patience to hang through the hard times. That turns out to be the case here as well. Which means if you're impatient, here's what happens. You buy the stocks, and then you get impatient, and you sell two of them, and one of them happens to be the big winner. There goes your excess return, something to factor into investment philosophies. And stocks that were both undervalued and underpriced consistently did better than stocks that were just undervalued or just underpriced. Now, I think people often make this an either-or. Do you want to do intrinsic valuation or do you want to do pricing? Why do I need to pick? Why can't I do both? Because ultimately, if something comes out as both undervalued, you've got two things working in your favor, right? Ultimately, does it matter to you whether you made money because the underpricing got fixed? Doesn't matter if it's the So having both work in your favor seems to strengthen the recommendation. Any questions on the intrinsic valuation part? There's one segment in the last session that I did not get to that I want to complete now because it is in the extension of intrinsic valuation. It's the value of control. In intrinsic valuation, each of you valued a company, you took a point of view on who was running the company, implicitly or explicitly. Most of you did it implicitly, and the implicitly might have shown up in extending what the company has done historically. The value of control comes from asking a second question. What would the value of my company be if someone else ran the company? It's kind of played out with Disney in the last few months, right? Nelson Peltz saying, I think the company can be run differently. And Bob Iger saying, no, I think I know how to do this. Bob Iger might have won that first skirmish. But this is a long-term war. If Disney doesn't come back, there will be somebody else asking exactly. And the second time around, Iger's hand is going to be much weaker. Right now, you could have said, look, Bob Chapek ruined the company and I'm fixing it now. But that's not going to work 1 year from now, 2 years from now, it doesn't come back. The value control is the difference between the value of the firm run optimally. And optimally, I'm using the word loosely because who knows what optimal is, run differently and better versus the value the company run as is. So if your company is already perfectly managed and perfectly run, the value control goes to zero. But if your company is badly managed and badly run, you will get a value of control. But the expected value of control has to bring in the likelihood that you can change the way the company is run. If you remember, when I valued Tube Investments, that Indian family group company, I came up with a company value that was low because the company kept growing by reinvesting in business and earning less than the cost of capital. If you ask me what the value of control is, I could give you a value of control in that company, saying if somebody, but then I'm going to say, look, there's zero chance I'm going to be able to change the management of this company. And if there's zero chance, the expected value of control will go to zero. So two things have to work for the expected value of control to be positive. One is the company's got to be badly run and fixable. And the second is you have a chance of changing the way the company's run. So let's summarize all the different ways you can change the value of a company. The first is you can look at current cash flows. So these are the pictures we looked at individually. You take in current cash flows and you say, is there something I can do to increase those cash flows? Cut taxes, pay less in taxes, be more efficient. On growth, is there a way I can, if I'm in a good business, that I can grow more by reinvesting more? That'll add value. But if you're in a bad business, the question you ask is, can I make myself more valuable by growing less? Because there, the growth is actually hurting you. On the risk, you can try to reduce your cost of capital by playing whatever games, changing the mix of debt and equity, matching up your debt. And to the extent that you have competitive advantages, if you have competitive advantages and you build up on them, and that was the last thing we talked about, maybe you can lengthen the growth period. So when you come into a company, you're looking at every dimension of what can I change in the company. And already you can see that the focus in a company will depend on where the company is in the life cycle. You come into a mature steel company, almost all of your focus is on increasing cash flows. And it's not on growth, it's not on, because in a sense, there's not much you can do. If I bring you into a company that used to be a growth company that is struggling, your focus will be on how do I increase value from growth? Which is one reason when CEOs acquire reputations in one company as turnaround CEOs. You've got to be very cautious in putting them in another company with a very different set of prompts. I'll give you a story, a guy called Al Dunlap. You've heard of him? No. You heard of Al Dunlap?
Yeah.
He was called Chainsaw Dunlap, is what was his name. And Al Dunlap was brought into Scott Paper, paper and pulp company, whose troubles were all about efficiencies. And he came in and he cut costs. And it worked at the company because that was their problem. He acquired a reputation as a turnaround CEO. And then Sunbeam, a company that had been around a long time, whose problems were not cost cutting, they were strategic, hired Al Dunlap because he had a reputation as a turnaround CEO. So Al Dunlap comes into Sunbeam. Guess what he does? So one trick pony, cut costs. Sunbeam's problem was not cutting costs, it was figuring out a strategy that would deliver them back to growth. He almost demolished the company. When you look at CEOs that succeed in one type of restructuring, it doesn't mean that they can go to another one because they're often using cookbooks. So when you look at a company, how do I turn this company around? The answer is going to depend on the company. So here are the two things that drive the value of control. First is the change in firm value. The second is the probability that you can change the management. And to make that assessment, you're going to look at the company. Does the company have takeover restrictions in its corporate charter? That makes it more difficult to change the management. Does it have shares with different voting rights? That makes it more difficult. This is, in the corporate finance class, this is the corporate governance part come into play. It tells you, this is the company where I have zero chance of changing the company. So if you're doing this, what's the expected value of control at Meta? The answer is probably zero. Why? Because Mark Zuckerberg controls 57% of the voting rights. So your discussion gets cut really quickly off if you cannot change the management of the company. So let's say you assess the likelihood of management change in your company. It could change over time. Until about 20 years ago, it was almost impossible to change the management of a Brazilian company. It still is very difficult, but then they created this new market with new corporate governance rules, because until the start of the century, almost every publicly traded company in Brazil had two classes of shares, what they call common and preferred, but really voting and non-voting shares. So if you bought shares in Vale, you were kind of stuck with what Vale did. And Brazil started to make changes in corporate governance. They haven't moved as far as they need to, but at least it now opens the door that if you're one of those companies, you have a better chance than you used to. The second is activist investors. To the extent that activist investors operate in your market, as they rise and fall, you're going to see the likelihood of management change go up and down. So that's why the fact that Carl Icahn has shown up in your company might be all you need to increase the probability of change in the company. Because even if it doesn't come from outside, it'll come from inside. And finally, every time you have a hostile acquisition in a sector, check this out, you're going to find that other companies in the sector start to get nervous about this coming, because hostile acquisitions often get focused in on sectors. So this has always been a tricky number to estimate. If you gave me a company and said, estimate the likelihood that management will change in the company, you're saying, how do I come up with that statistic? I don't know whether you've ever used the statistical technique called probit. It looks like a regression, but in a probit, here's what you do. Let's say you wanted to estimate the probability of management change at a US company. You go back over the last 20 years, you take every US company, and you break them down into companies where management was changed and the companies where management wasn't changed. So let's say 200 companies, management was changed, and 5,000 companies, it wasn't changed. Then you collect data on things that you think might lead to that change. Things like, how well or badly has the stock done relative to the market in the recent years? Because we know that you see change more often in stocks that underperform. You might throw an insider percentage as, how much do insiders control of the company? So you take a bunch of variables, and you got these 200 companies where there was change and 5,000 companies where there wasn't. In this probit, you put a 1 on the companies that change and a 0. So the dependent variable becomes like a dummy variable. And your independent variables, and then it looks very much like a regression, but when you're done, that output that you get from the equation will give you a probability of change that between the 0 and 1. So if you have companies that look very much like the 200 companies that saw change, you're going to see a probability closer to 1. If you see companies very different, the number can go back down towards 0. So it's a technique that does require some degree of statistics, but we have the data now to do it. Incidentally, those of you familiar with the Altman Z-score, the Altman Z-score came out of doing something like a probit in the 60s, looking at companies that defaulted and companies that did not, and coming up with a measure of what are the things that explain why some companies default. So I'm going to talk about 4 scenarios where the value of control can be useful in thinking about how much should you pay for a company. First, I'm going to argue that in every publicly traded company, there is an expected value of control in the stock price. And I'll talk about because it's implicit. You're saying, where the heck is it? It's in there. And you can argue that, that will depend on how well or badly the companies run. So that expected value of control will be smaller and well-run companies, larger and badly run companies, the likelihood that there will be change. Second, I want to talk about how the value of control plays out in hostile acquisitions. Remember, we talked about control premiums. We'll talk about how that plays out in an actual acquisition. How do you value control and how much do you pay for it? Third, I'm going to argue that understanding the expected value of control will give you a way of explaining why voting shares trade at a premium over non-voting shares and how much that premium should be. Right? And finally, in private company transactions, there's something called a minority discount. What is it? If you buy 49% of a private business, you pay substantially less than if you buy 51% of the same business. Why? Because the existing owner runs the business. If you buy 49% at 51%, you control the business. That 2% difference in ownership stake can lead to a big discount in value. That's called a minority discount. So all are examples of this expected value of control. Let's start with publicly traded companies. when you look at the stock price of a publicly traded company, the market is valuing the company run as is, but the market is also implicitly valuing the company run by somebody better. And it's attaching an expected value. You might remember when I did Hormel Foods, I did a variant of this, valued the company twice and said, look, the stock price tries to reflect that likelihood. So you have two values. Let's say the value of the company with the status quo is 30, and the value of the company run optimally is 40. And you think there's a 20% chance of management change. You see where you're going to end up, right? You're going to end up at $32, which is the expected value between 30 and 40, putting in a 20% chance of change. If you've noticed, Disney stock price has done relatively well over the last few months. You know who you should credit for that? There's a status quo value at Disney, and there is an optimal value. It'll be interesting to ask what that optimal value will look like, because as the entertainment business is broken, we don't have a clear idea. What's changed the property of, that management will have to adjust? The presence of Nelson Peltz. The minute he came in, the property started rising. And even though he's viewed as having lost the battle, he made a lot of money on his investment, because by increasing the likelihood of change, he's moved the price from close to 30, closer to 40. I don't take this as an extra assignment because it's too late. Your project is due at 5. You could value each of your companies a second time. And this time you can say, if I ran the company, what would I do differently? So if you ran AMC, you might say, look, I'm not going to go for growth. I'm actually going to shrink down to 20% of the theaters I have. I'll make them all IMAX theaters. And I focus only on movies like Avatar and Star Wars, which you want to go see them It's not my company. I can't do that with AMC because a crazy man runs a company right now, and he's going to do whatever he's going to do. But with each of your companies, when you do that with change, what would I do differently? You're effectively trying to answer that question. So when you look at the price of a company and you see the price moving and you say, what changed this company? It might be the fundamentals, but it also might be that people are assessing a higher likelihood that there will be a shift in the management of the company. In acquisitions, and this is actually a very pragmatic question. You have a company that you see as badly run. Blockbuster in 2005. Blockbuster had a pretty glorious 1990s. You remember how the company was built? It was the ultimate roll-up, right? What Blockbuster did was it went town by town, city by city, buying privately owned video rental stores. Most of you are too young to remember a time we had a video rental store in every other block. You walked in and there were all these tapes and you borrowed a tape, and if you didn't bring it back in time, they would charge you an arm and a leg. When Blockbuster probably made a third of its money from late fees. Okay? But it was a huge growth business because everybody had a VCR. They, of course, didn't have enough tapes. And Blockbuster was created as a roll-up. So they open every month, they would open another Blockbuster in another part of in another town or in another part of the town. And through the 90s, it worked really well. Then two things happened that broke the Blockbuster model. You know what the two are? When was Netflix born? Remember? It's the late 90s. The original Netflix was actually, they mailed you a tape, right? So, no, but first was tapes and then it became DVDs. So basically, so they mailed it to you and you mailed it back and they had no late fees. So the first thing that happened was, people used it. The other was Walmart started having, at least with the most popular movies, that $2 and $1, you could actually, get it out of like a vending machine. You could put so basically Blockbuster got squeezed in both directions. Walmart was taking away the big rentals, which are accounted for a third of the rentals, those big movies. And Netflix was coming from the other end. And Blockbuster's business model was breaking, but Blockbuster's management is completely oblivious. Oblivious in what sense? They kept opening another 50 stores because that's what they'd always been doing. By 2005, people are looking at Blockbuster and saying, what's wrong with you guys? You keep opening stores, nobody's coming into them. So if you did a status quo valuation of Blockbuster, the value that you'd have got would have been like $6 or $5 per share. But if you just took a very different model of Blockbuster where it narrowed the business down, focused in, and maybe they could have got into some of the streaming business that the value you got was $12.50. The stock was actually trading at $9.50 at the time because activist investors were already in the company. They had pushed the price up from $6 to $9.50. Let's say you came along and you're a hostile acquirer of Blockbuster. You've estimated the value at $12.47 with all the changes put in, right? Would you pay the $2.97 as a premium to acquire Blockbuster? You could, right? And if you do, if you pay $12.47, what's the net present value of your investment going to be? If you buy something at fair value, what will you earn as a return? No, it's not zero. You will earn your cost of equity and cost of capital. In effect, that's what fair value is. Fair value doesn't mean it's a bad investment. It means you'll earn so in effect, you're going to do all this work and you're going to make the same return you could have made if you'd bought an index fund. That doesn't strike me as a great trade-off. So if you're acquiring a company for control, you got to keep some of that difference for yourself. Whether you can or not will depend whether you get into a bidding war. But that premium is going to be shared between you and the target firm. And you want to keep some of it because you're going to do the dirty work of fixing the company. So when you see hostile acquisitions and people talk about value of control, you got to be very careful that you're not paying the entire value, that you're at least trying to keep some of it for yourself. Let's talk about voting and non-voting shares. Used to be in the US, when I talked about this, people say, why are you talking about this? Nobody in the US is voting and non-voting shares. And in 2001, there were like a handful of companies, Viacom, Ford, which had voting and non-voting shares, primarily because they were grandfathered in. One reason you did not have voting and non-voting shares in the US was the New York Stock Exchange explicitly required that if you're going to be listed on the New York Stock Exchange, you couldn't have two classes of shares. And in the last century, that was the aspiration. Every company wanted to end up on the New York Stock Exchange because this was the days of physical trading on the floors, and this was where the trading happened. So late 90s, NASDAQ decides it wants to be a growth index. I mean, remember, all these, all these exchanges are themselves businesses. They want to attract people in. And I think this was actually feckless on the part of NASDAQ. They decided that one way they could make themselves more attractive to the young tech companies who were being listed is they said on the NASDAQ, we don't care about you having voting and non-voting shares. So late 90s, they passed this rule. Initially, though, companies were too scared to go out and open that door. They were worried that institutional investors would punish them if they had voting and non-voting shares. And then, of course, Google decides to try it anyway. And institutional investors, rather than punishing them, rewarded them. So now voting and non-voting shares are very much part of the game. So if you look at Facebook, there's a Class A and a Class B shares. Google, Class A, Class B, Class C. Class A shares have 10 times the voting rights of Class B shares, but Google said, I haven't insulted you enough. We're going to offer Class C shares. We have no voting rights at all. So you have three classes of shares. So let's say you value, anybody value Google or Alphabet, as they prefer to call themselves? You don't want to admit to it? So you got an equity value for the company, right? And then you divide by the number of shares. But remember, there are three classes of shares. Right now, what we do is we add all three classes and we divide the total equity value. In effect, we're giving Class A shares, Class B shares, and Class C shares. Roughly the same value. It's not a big deal for Google because the non-voting shares are so much larger as a count than the voting shares, you can get away with it. But let's say you're in a scenario where you had roughly the same number of voting and non-voting shares. I take the total equity value. Before I divide by the two classes of shares, you're probably going to say, but the voting shares should have a higher price than the non-voting shares. Bankers often put in an arbitrary premium, 0.5%, 10%, they base it on studies. But let's step back and think about how in an intrinsic value world, you might value voting and non-voting shares. It's actually Embraer, a valuation I did in Embraer way back in time. I came up with a status quo value of 12.5 billion riyals. I did an optimal value. There were things I thought I could fix in Embraer of 14.7. So you have two numbers, 12.5. The company had 242.5 million voting shares and 477 million non-voting shares. So let's say you guys are going to buy the non-voting shares, you're going to buy the voting shares. If you buy the non-voting shares, you're kind of stuck with the status quo, right? There's nothing you can do. You have no voting rights. So here's what I did to value the non-voting shares. I took the status quo value and said, guys, you're stuck with it. There's nothing you can do. Divided by the total number of shares outstanding. The value per share that I got was 17.38 reais per share. And then I took the value of control, which is really the difference between those two numbers, multiplied it by the probability that there will be change, which is low. Because if there's going to be change, it's got to come from the government pushing for change or one of the big entities, but there's a chance, a 20% chance. And then I took that expected value of control and divided just by the voting shares. You see the logic here, right? If you have a voting share, you get a chance on voting on control. So I'm going to take the expected value of control and give it entirely to the voting shares. I came up with the value of 19.19 per share. So the voting shares traded a premium over the non-voting shares. Let me ask you a question. What has to happen for the two shares to trade at roughly the same price? Take a look at that equation and say, give me the conditions under which voting and non-voting shares are going to trade at roughly the same price. Gandhar?
The probability of management change is 0.
So already you can see with Google and Facebook why we get away with doing what we're doing, because if you have zero chance of changing Zuckerberg's, his place at the top, you're going to basically pay the same for more. The more you can create change and the worse run a company is, the bigger the difference will be between voting and non-voting shares. In fact, in Brazil, until about 2002 or 3, the common and preferred shares used to trade at roughly the same price. What happened in 2003 was a pretty well-known acquisition of Ambev by a Brazilian brewer called Ambev. And I owned Ambev shares then. I was very excited at the acquisition. It was a 50% premium. So I'm sitting there counting my money already. And then the acquisition goes through. I owned the preferred shares, the non-voting shares, and I get like a 4% premium. So what the heck happened? It turned out that the voting shareholders had arranged a side deal. They said, you need us for control. And they got almost all of the premium, and we got and all of a sudden people in Brazil woke up and say, we're crazy buying these preferred shares. We have no voting rights. Why they had to have an Ambev incident for wake them up. But that's, after that, you saw the difference between common and preferred shares open up as people said, there is a problem here, and it's got to be reflected in lower prices paid for non-voting shares. So again, an expected value of control gives you that capacity to go beyond just attach a 10% premium. Which leaves me with the final example, minority discount. Let's say I value a privately owned candy company. And remember the privately owned, you think about total betas and all the rest. Let's say you value it twice. Again, status quo value, optimal value. Status quo value is 1.6 million. But with changes put in, you think the company could be worth as much as 2 million. If I offer you 51% of the company, think of the most you're willing to pay. It'll be your company. You can run it optimally. You're willing to pay up to 51% of 2 million, which is 1.02 million. But if I offer you 49% of the same company, 49% of 1.6 million is 784,000. Again, the worse run the private company is, the bigger the minority discount should be. The Mets used to be owned by the Wilpons. And New York is cursed with owners who seem to ruin teams. You got the Knicks with the Dolans, and under the Wilpons, you actually could buy 3%, 5% of the Mets. And if you looked at the pricing for 3 or 5% of the Mets when the Wilpons were in charge, it was much lower than what you were paying for big name teams with big franchises. Why? Because you're getting a minority stake in a badly run team. Until Steve Cohen stepped in and offered basically, I'll buy. You can already see that if you're going to buy the whole team and you're going to run the team, you can make changes you cannot with a minority stake. And that's what the minority discount captures. So the expected value of control is an interesting concept because you can use it to talk about lots of different things going on in the market. In fact, a few years ago, somebody from one of the emerging markets reached out and said, we're going to try to reform corporate governance in this market. How do we frame it as being good for investors? This is a market where corporate governance was dead in the water before that. Nobody had ever done a hostile acquisition in the market. It just was impossible to change management. I said, it's easy. Right now, the stock prices of every company in the market are being priced at status quo value. There's no expected value control because you can't create it. If you can open the door to corporate governance, it's not like every company is going to go to the optimal value, but you've increased the probability of change. And even if nothing else changes, nothing fundamental changes, you should see stock prices go up. And they should go up more for the worst run companies than the best run. It's kind of counterintuitive. The best run companies, who cares that the corporate governance laws change? But the worst run companies, you should see an increase in the price. Now, they ultimately tried and they gave up because there was too much pushback from the corporations, but you can frame that as the reason corporate governance matters. Without corporate governance, everything trades at status quo value. So as you can see, changing value is hard work, right? In the spreadsheet, they increase cash flows from existing assets. Somebody's got to be firing employees, cutting costs, running things more efficiently. Increase value from growth, easier said than done, because reinvest more. You've got to find projects in other countries and other businesses. People don't like to do hard work. CEOs are looking at, give me a shortcut. This is too complicated. So 3 minutes into a DCF, what is this growth margin thing? Give me something, one number I can keep on my desk and watch. And consulting firms know this. And the history of consulting is you come up with acronyms, magic bullets. You say, hey, just focus on the magic bullet, this DCF stuff, too complicated. And every consulting firm creates an acronym that's usually a shortcut. So there is some logical link to value. And then as a consulting firm, you've got to make yourself indispensable. What does that mean? That acronym, oh, you need McKinsey to come in and do it, or Bain to do it, because you can't do it yourself. They made it complicated enough. There's some proprietary. So as an example, in the 1990s, this outfit called Stern Stewart, a consulting firm is New York based, comes out of nowhere. It's run by two guys, Joel Stern and Bennett Stewart, that I've known for a long time. And neither of them is that deep. Right? Joel Stern's big thing was don't pay dividends. He spent 30 years saying dividends are bad, don't pay dividends, which at the core you cannot make some tax argument, but that was the depth of his corporate finance. And Bennett Stewart was just a salesman. He could sell refrigerators to Eskimos. And they founded this, and they came up with an acronym called EVA. I'm supposed to put a little R in brackets every time I use EVA, but Stern Stewart is now bankrupt, I think. I don't think they can even sue me. How can they hire a lawyer? Right? For a long time, I put the R in just in case. I'll tell you what EVA is, and you tell me whether this is mind-blowingly new to you. EVA takes the return on capital and compares it to the cost of capital. So it says companies should earn more than their cost of capital. Amazing insight. I never thought about this until you said it. And then they multiplied it by, this was the innovation, they multiplied by capital invested. So their point is, it's good to earn more than the cost of capital, and it's even better if you can do it on big projects. And they sold it like crazy. At one point in time, at Stern Stewart's peak in the 1990s, half of the S&P 500 had bought into EVA. And you're saying, well, how did Stern Stewart make money? EVA, according to Stern Stewart, so remember the return invested capital is after-tax operating income divided by invested capital. If you remember, we capitalize R&D and we capitalize lease. We talked about all the things that can go wrong. Stern Stewart came up with 164 adjustments you needed to make to come up with the true return invested capital. I think 3 added, 161 were noise. That's the other thing to remember at consulting firms is you throw a lot of noise into the process. You don't know what matters. And Stern Stewart would come in every 6 months or a year and compute your return on invested capital for you, give it to you as a CEO. And here's what created the hub. They then advised management to tie their compensation to EVA. I wanted to think about the most perverse ways you can increase EVA. Perverse in what sense? Ways of increasing EVA while ruining your company. So there are 3 numbers in there, right? Return on invested capital, cost of capital, capital invested. So think out of the box. Think about your bonus is tied to this number. You want to increase your bonus even if it means destroying your company. So tell me some of the ways you can make it. Larry?
Over leverage yourself to lower your cost.
You could, let's see how, so if you over lever yourself, first, your cost, if you do your cost of capital, right, over levering yourself won't help you, right? Because but if your cost of capital is miscalculated, adding debt can make, so one is you play the seams of the cost of capital calculation to see if there are flaws, and then you take advantage of those flaws to make it look like your cost of capital is lower. What else?
Lower investment.
There's not a cash flow number there. That's a part of the problem, is there is no growth or reinvestment. But do companies sometimes face the choice of things that could increase their operating income now, but lower growth in the future? I mean, remember, these were the days where R&D was adjusted to get to earnings, right? So if you're a company and you cut your R&D down to the bone, your operating income that year will jump. Your EVA that year will jump. But remember, your value as a company is not the value of EVA next year. It's the present value of all your future EVAs. You kind of traded off higher EVA today for the future. It's a growth trade-off. There's a risk trade-off, which is to the extent that it takes time for the cost of capital to catch up with riskier and riskier business that you get into, you keep climbing the risk ladder. And as you climb, at least initially, it looks like you're beating your cost of capital. You would take advantage of what goes into capital invested. In the 1990s, if you leased something, it basically didn't show up as part of invested capital, right? Because it was an operating expense. But if you borrowed the same amount, it meant your invested capital went up. You had to make much more money to break even. So companies would lease stuff rather than buying stuff. The gaming went crazy. And if you ask Stern, it's not our fault. It's managers gaming the system. You created EVA, you tied compensation to EVA. What the heck did you think would happen? I mean, they used to drive me crazy with their sales pitches. I remember being at one where Bennett Stewart held up, at that time, Coca-Cola was viewed as one of the great success stories. He held up an annual report. Said, this is Coca-Cola's annual report. Coca-Cola uses EVA. Do you want to be Coca-Cola? It's like one of those high school logic classes, A leads to B, B leads to C, A leads to C kind of thing. And the first time I heard it, I almost fell out of my chair. Next time I started bringing these Air Jordans with me whenever I ran into Bennett Stewart. So when he did this, I wait for my turn. I take off my shoes and put on the Air Jordans. And people say, what the heck is this guy doing? I sometimes brought a box of Wheaties as well. So after I put on my Air Jordans, I take a bowl of Wheaties and then I say, can you point me to a basketball hoop? I'm going to slam dunk a basketball. Michael Jordan eats Wheaties. He wears Air Jordans. And you know what? My capacity, my leaping ability is like 6 inches off the ground. The only basketball hoop that I can slam dunk on is the Fisher-Price one that you get for little kids. I can eat all the Wheaties in the world and wear the most I'm not slam dunking a ball. Coca-Cola did not get successful because it used EVA. It was an accidental choice. But consulting firms oversold it and people lapped it up. You can't just blame Stern Stewart. You have to blame the CEOs who wanted something so simplistic that they stopped asking questions. Around the same time, perhaps a little earlier, there's an outfit called Holt Associates in Chicago that came up with CFROI. You're saying, what's CFROI? You know how we compute IRR for a project? We take the cash flows. They actually took existing cash flows and figured out a way to use them to come up with an IRR for a company. So they said, this is not earnings, it's cash flows, but it's based on existing cash flows that they took the operating income, added back depreciation, came up with some concoction. Again, sold it like crazy. CFROI can make you wealthy. The bottom line is all of these approaches just take that basic equation you had for discounted cash flow valuation and just frame it differently. It's old wine in a new bottle. There's nothing particularly new about them. And as you go through and you look at at value consulting, and it's still true when you look at McKinsey and Bain and BCG, and they come up with a new measure every year, every 2 years. What they're doing is taking that basic equation, coming up with a simpler version, because that's what appeals to CEOs. Just focus on these 3 numbers, everything will be okay. But anytime you simplify the valuation process, I can almost guarantee you that over time, people are going to find a way to gain it. Okay? So when you do run into one of these shortcuts, push at its weakest link, because you can almost guarantee that over time, that weakest link is going to be tested. So let's return to what you were doing. So when you talked about pricing, remember that 4-step approach to kind of keep you honest. Define, make sure your multiple is consistently defined and uniformly estimated. At the risk of sounding stupid, when somebody says the PE ratio for this company is 12, ask them, how do you compute PE? Because you can divide by current earnings, trailing earnings, forward earnings. I don't even know what the 12 means until you flesh it out for me. Make sure it's consistently defined. Numerator is an equity value, denominator, and it's uniformly estimated. Same way for all 15 companies. I got quite a few of you emailing me over the weekend saying, should I use trailing earnings for my company when I do the, when I've done the pricing, should I use trailing earnings and forward earnings? And my answer was always the same. What did you use for your peer group? If you use forward earnings for them, you got to use forward earnings for yourself. If you do trailing earnings for them, you have trailing earnings. This is not about what's right or wrong, it's being consistent. So that's the first stop. Second stop, describe the multiple. After this exam is done, rent Moneyball again. Watch it, because it's about using the data. This is not about finance, it's about pure statistics. Get a sense of what's high, what's low, what's typical by looking at the data. Third, if you're using pricing because you don't like to deal with cash flow, growth, and risk assumptions, think again. Every time you use a multiple, you are implicitly making assumptions about cash flow, growth, and risk. And if you forget that, just go back to that basic discounted cash flow model. A dividend discount model, you can get any equity multiple. An enterprise value model, you can get any enterprise value multiple. And remember, no matter how carefully you try to do this, your peer group is going to be different from your company. Many of you ran into this. And the problem with storytelling is you run into walls sooner or later. I know I kind of pushed regressions on you. Regressions are a tool. The reason I think they're a useful tool is it kind of gets past the storytelling, say, how much is growth being priced at in this sector? And so there are the variables that drive the multiple. In an intrinsic value world, these are the things that should make the price earnings ratio higher for some companies than others. Price to book ratio is higher. And with every multiple, I talked about a companion variable, that one number you need to know to use that. With PE, it's growth. With price to book, it's return equity. With enterprise value to sales, it's operating margins. And I'm not pulling these numbers out of thin air. When you do the DCF, that's what you would see coming up. So here's what you did. A lot of EVs over time. Like if you look at this trend line, 20 years ago, equity multiples used to be half the company. So over time, you see this moving away, partly because leverage has become much more different within peer. It used to be that all steel companies had roughly the same debt policy. Now you can have steel companies with very little debts. Even airlines, you're seeing divergences in how airlines get funded. And the more differences there are in leverage across companies, the more you're going to go with enterprise value multiples rather than equity multiples, because that's your only way you can control for that leverage effect. Enterprise value sales, almost half your companies. Some of these companies, it was desperation that drove you there, right? You kept climbing the income, not negative, 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 negative. And the only positive number you ran into was revenues. I don't think anybody did a pre-revenue company in this class. But by now you have the tools to do a pre-revenue company, right? It's the same tools you do with a small revenue company. The only difference, you start with zero, but remember, even with a small revenue company, it's not the starting number that drove your value, it's your ending number. So if you have a pre-revenue company, that multiple might be enterprise value to users, subscribers, members. There were 2 used EV to EBIT, 12 PE and 14 price to book. Many of those were financial service companies. You went to price to book because it works. So first thing I did was I compared your DCF value to your pricing. I want to know, because there is this canard that DCF value always gives you a lower number than your pricing. That turns out not to be true. Even in your group, 42% of you did find your DCF value to be greater than pricing, 58%. So there is this imbalance. Pricing gave you a higher number. That number shifts over time. So basically, you can see the breakdown. The median is about 87%. So median company, the DCF value you got was about 87% of the pricing. So your pricing gave you a higher number. When you get that consistently, that tells you the market's getting a little richly priced, when you're getting the pricing deliver a higher value. And in terms of your pricing results, your median company was overpriced by about 5%, much better than your DCF, right? Where you got a 28% overpricing, but that's to be expected. Pricing should always lead you closer to where the market is today. But even on this dimension, 43% of your companies were underpriced, 57% were overpriced. So even on the pricing dimension, you're getting a lot more overpriced companies than underpriced companies. So here are the most underpriced companies on a relative basis. Again, what is that? I'm not familiar with the company. Heliogen? What does it do? Is that your company? Okay. Because it was also the most undervalued, right? Are you buying?
Yeah.
Okay. Okay. So what do they do? Okay. And they're US based or they? Okay, so I'm going to read up on the company because when it shows up on top of both lists, that's interesting. It might be that you really like the company, but I think that it is unusual for a company to show up as best on both lists. And you go down, most underpriced, Disney is on that list. I was surprised Taiwan Semiconductor made it on the list because if it's, on a pricing base. But part of the reason is NVIDIA is pulling the pricing for the entire sector up so much that you might reach a point where NVIDIA is the only overpriced stock, but at $2 trillion, every other semiconductor company looks cheap relative to NVIDIA. So nature of pricing is you're making a comparative statement. Most overpriced on a relative basis. I hope this is not true because I own Meta. But Sydney, that's your company, right? That's your pricing. Your DCF value did give you a more. I'm looking for some kind of comfort here. No.
Yeah, I think I put my trust.
Yeah, and so, but you did sell still. Yeah. But the DCF value was like 400, 350 or something like that, closer to the 400. I'm not surprised that it's overpriced because given, the comparisons, given how big Meta is, it's priced very richly right now. But that's it's a red flag, something to think about. It is clearly, there are better bargains on a pure pricing basis. Indigo, Pari, is that yours?
Yes.
And most of Indigo is an Indian airline, and the airline business is a fiasco all over the world. India is no exception. But again, I think I'm not surprised to see it on the most. What did you price it against? Other airlines or?
I priced it against 6 other airlines. And
all Indian airlines?
all international airlines.
Right.
We didn't get much data from the India. There was only Air India there. But, so initially when I priced it, I emailed you the DCF. The share was valued.
You're trying to blame me now for the whole thing. Okay, that's okay. Yeah.
The share was valued at 3,000 Indian rupees.
Yeah.
It's already gone up to 4,100. So I had
So it got even more overpriced while you were doing it.
Yes. And I had put a buy recommendation when I initially valued it, but it's moving up pretty fast. It goes close to zero debt, just 0.1% debt.
Okay. That's unusual for an airline. They don't lease their aircraft?
They do, but I guess they are not
Yeah,
capitalized.
so maybe they have a lot of debt and you don't know it, right? Because I'd be very surprised to see an airline with, unless it's Emirates or something where somebody rich can buy the aircraft. It's very difficult for an airline not
They
to
have a
have debt.
mixed bag of owned and leased, but I
But
guess
still,
the
they'll be
Indian
leased.
economic standards, they are not capitalizing the leases.
That might be something worth looking at as well, because that might give you a different perspective of the company. David?
Why would you own Meta? Because even in your own DCF, it's, I think.
Because I bought it at such a low price. At this stage, I've got to pay I'll tell you how much I have to pay in capital gains taxes, right? It's got to get overvalued by a significant amount, far more than it was undervalued for me to sell it. Because I made the unfortunate mistake of choosing to be a California resident. Okay. And in California, you have to pay ordinary income taxes on capital gains. So I have to pay 23.8% at the federal level. You're already starting to feel sorry for me, right? I mean, it's so sad when you have to sell something. But you add that up, it's almost a 35% tax rate on capital gains. So that's a big issue as to when you sell. It's got to get overvalued enough. I own all 7 of the Max 7. Tesla is the only one I added recently at 170. The others were there because I got lucky. NVIDIA, I have 1/4 of the position I used to have, but it's still in there, so. Actually, Sydney, there's another Meta on that list as well. So you're not alone in believing it's overpriced. That other Meta has twice the pricing of yours, so which can happen, right? Your peer groups can be different, so you can end up with different multiples, but they're both delivering the same message. Yes, ma'am.
Just as a sidebar to the
Yeah.
discussion, I really about to go on because I did Air Canada.
Yeah.
If you think that airlines are like, it's virtually impossible for an airline to ever make back its cost of capital in terms of returns. Is that like an argument? Are you saying that like you shouldn't have private sector people investing in airlines? They should all be government owned because like,
They used to be all government owned. That didn't go well. I think it's just a bad business. And I think we need to find, you know what, how do bad businesses go back to being good? I mean, let's face it, we all fly. So it's not like airlines or something. It's unlike, the movie theaters where we're not going anymore. We're all flying more than we ever did. So if you look at the total money spent on airlines, it's much higher. It's the way the airline business is structured is just bad, right? I mean, it's just bad because it reflects the way I describe it is airlines are still structured as if it was pre-1977. 1977 was when the airline business was deregulated in the US. They're still structured as if they own a route and they can have pricing power. And their hope always is, this is the only way I can explain how the airline business grows, is they hope that the bad airlines will fall off and that will consolidate. And for 50 years, they've been hoping it, right? But here's what seems to happen in the business. The bad airlines fall off, and guess what happens? Another discount airline pops in with an insane business model. They're just, gambling on making it. So it's a business where new entrants get in, and the really bad old national airlines never go out of business, right? Because, if you don't want, this is your nation's name on it, you don't want it to go away. So it's a business where what would naturally cause the business to fix itself has not been allowed to play out, which is let the bad airlines go out of business, let their routes be bought up by other airlines that run the business differently. But because you don't let the old airlines go out of business, they hold on to the routes. Remember, without the routes, new entrants can't come in, right? I mean, Virgin Atlantic, when it tried to grow out of the UK, British Airways owned almost every gate in Heathrow. It shut Virgin Atlantic out, which is the reason early on when you flew Virgin Atlantic, you almost always flew to Gatwick, not Heathrow. And that's happened in a lot of countries. That's the problem, is the big routes, the lucrative routes are owned by airlines that are broken airlines, but they continue holding the routes. So this is a classic case example of what happens when an industry structure is not dynamic and the business is bad. It takes a really long time to fix that business. There's been more consolidation, but when you try to consolidate, the antitrust people come after you. So you get squeezed from all sides, which means there is no light right now at the end of the tunnel for this business turning good. But we're all going to need to fly. Somebody's got to supply the aircraft. I don't think governments have where are they going to come up with the money, right? Maybe the Sultan of Brunei can fly us all over the world, and we, because that's the only airline that is growing, right? The Middle Eastern airlines, partly because they're so heavily subsidized. And it's become a symbol of national pride. And maybe that's where we'll end up, is trophy assets. I did ask you to try to see if an option pricing model works. But I then also warned you that in most of your companies, it's not going to work. Because you have 2 things you need for a liquidation option to work. One is you need a money-losing company because it's a liquidation option. You can't be a growth company. It's a pretty mature company. And the other is a lot of debt as opposed to that. Just
I have a question.
Yeah.
It has to be a lot of debt. Why? Because of the volatility? Or
because
of
the optionality comes from the fact that if the value of the assets is greater than the debt, the equity is worth a lot. The value falls below the debt, it's worth nothing. It's a disproportionate payoff that you're going for, right? That if the value, so take AMC. AMC right now is 1.6 billion. And your equity is, let's say, close. If it goes to 10 billion, barely above that 9.4 billion in debt, that 600 million in equity might not sound like much, but relative to the 150 million you paid up front, that's a 400% return. That optionality comes from the fact that equity is a tiny slice of the company. And any improvement in the assets becomes a disproportionate increase in equity. Same thing in real estate, right?
Mathematically, is it because like when you do the minus K times E?
Yeah, the K is zero, there is,
Also the price of the ball would be close
there's no
to
optionality. If the K is zero, there is no optionality, right? Because you don't get that limited loss feature, which comes from the fact that S has to be less than K. Every company also has an option value. The thing is, most healthy companies, that option value is tiny relative to the going concern value. And in fact, there were 14 of your companies where you did apply the option pricing model. I compared what the option value came up with was relative to your DCF value, and no surprise, you got that premium over the DCF value. I mean, you can try that. Noah, did you try that for AMC? Was there the option? I haven't checked that, but what the option pricing? Did you get an option value for AMC that was positive?
Positive, but below.
But at least you got a deposit. That's an accomplishment by itself. You got it above zero. That's your only explanation I can give for why people are buying AMC stock. Because you're saying, where will that upside come from? I mean, if the value of AMC falls enough, I would think that Disney, this is actually the exact kind of company that Disney should have acquired 6 years ago. Why? Because Disney, more than any other movie company, is dependent on the movie theater chain in the movie business. It can't afford to let AMC go under. Might as well buy AMC and make it part of Disney. I'm sure some antitrust law will kick in, right? But or Amazon, right? You're big in the entertainment business. I mean, who knows what else Amazon can sell to their movie? I mean, they bought Whole Foods, right? And paid a big premium, not because they thought they could turn Whole Foods around into a money-making business, but it became a part of their ecosystem where they could bring it in. So that's what you're buying it, you're hoping for when you buy AMC shares. It's something like that will happen. But talk of bankruptcy is swirling around you. So it's entirely possible. Nothing good will happen. Your equity is going to go to zero. And you're going to say, I wish I hadn't done that. So you finished your valuation, your pricing. And I should have counted. About, I think, a third of your companies were both undervalued and underpriced. About 40 to 45% of your companies were both overvalued and overpriced, which is extremely convenient, right? It's so easy to write that final paragraph when both point in the same direction. It's when the two give you different signals that what the heck am I going to do now? And even if they give you the same signal, that final choice of buy, sell, I mean, every year my hope is that nobody will say hold. There were quite a few of you said, can I say buy/hold? No. You either buy or you hold. I have to even push people to make a choice because your natural position is to let me just straddle. I'm glad nobody said, can I put buy and sell? That way you're covered no matter what happens. No. But if your view is, I don't feel sure yet. Let's be real, you will never feel sure. Investing is about taking positions when you still feel uncertain. Right? Yeah.
Have you ever had anyone suggest like you could short for a company?
They suggest it, but they don't do it, right? It's one thing to suggest that you sell short in NVIDIA. Do you really want to mess with that in the next month or two? I mean, you're just as likely to go bankrupt as make money, right? It could go to 1,500. Eventually, you're right, but you're in debtor's prison, saying, I was right 6 months ago. It doesn't help you, right? So people say, but I've never had somebody actually sell short. Do any of you going to sell short in your overvalued companies? Let me know. I'm not going to follow you. But I will watch your social media posts to see how your mood is going over time, because it might be an interesting exercise in how this plays out. Also, I think it's very easy to talk about market inefficiencies, right? Markets make mistakes all the time. And one of the things I think you learn as you value and price companies is how messy this process is. I'll be quite honest. I know I respect markets. I don't believe markets are efficient, but I'm always amazed at markets' capacity to come up with one number for a company like NVIDIA. To take all those people, very different views, and it's an incredibly efficient process of delivering a number. And finally, let the law of large numbers work in your favor. The reason you feel reluctant to push, to pull the trigger on the company you find is undervalued is you have one company, which, as you saw, even if you do all your homework, you're going to be wrong. But let's say you do this on 10 companies, you value them, and you feel you're bringing something to each valuation. Do you see the advantage of taking a position on 10 undervalued companies as opposed to one? Assuming you bring something to the table, all you need is on average. And that's something I think, when I buy a company, the reason no company in my portfolio exceeds 5% of my portfolio, which means I can afford to take a jump on Tesla. And if I had to put all my money in Tesla, I'd be freaking out. But to put 5% of my money in Tesla at 170, I feel I can go with it. So here are your recommendations. You had 29% buys, 52% sells, a buy to sell ratio of 0.56. You're definitely not sell side equity research analysts, right? There, the ratio of buy to sell is 900%. You're far more sells than buys. Yes, David.
Have you seen that ratio evolve throughout the many? Sorry.
There you go. That's the history of buy and sell. I think the lowest it hit was in spring of 2015, and you're very close to the lowest. This is one of the lowest buy to sell ratios I've seen in the last 20 years. I am not sure I trust your market timing, but you can see how you can use this as a market timing mechanism, right? The buy to sell ratio gets really low and you believe the crowd. You basically say, I'm going to put less money in equities or take my money out. So it's a scary number. It's a number that I will think about for the next week. And hopefully by the end of the next week, when you get this sold, you forget the number and I will keep going. But it is a number that is a little troubling, that higher percent. The undergraduate class was 6.67. So that class also had a really low, and they had 300 people in that class. So this is something that is clearly coming across. And perhaps it's the fact that markets have gone up so much so quickly, and the sense of unease we all have. In fact, yesterday I was reading about this thing called financial dysmorphia. I was just, what is financial dysmorphia? It's the fact that people are, their view of their current financial standing is very different than the actual standing. And some of it is fed by social media, some of it is fed by the news stories they read. But I think part of the reason there's so much angst among especially young people is there is this disconnect that's happening between what they actually have and what they think they have or how much they're behind. And the one reason for that is housing prices doing what they are, essentially taking something that used to anchor people. That's what used to cure everybody's financial distress. You bought a house, it was your starting point for building up wealth. And that's become so much more difficult. Lada?
I was just gonna note that it's interesting that it trends down over the past couple years.
Yeah, and in fact, that tells me that that as the market's gone up since COVID, so it kind of the COVID year you started to see a lot more buys than sells, and then it's trended down. So ultimately, pick your value. I'm not going to tell you one is better than the other. It depends on what you value. So remember this question I asked you at the start of the class? What do you believe in? Revisit that question now that you've tried your hand in it. It's not abstractions anymore. You've seen how the sausage gets made, and you might say, no, I'm just going to go to a restaurant. I'm not going to make it myself. No, that's just what you do when you buy an index fund, you buy a fish. So again, you have to make your choices on what works for you. So if you're a storyteller, I hope that you've started the process of getting more confidence in your number crunching. So you walked into this class not knowing what a return invested capital is. Even if you never ever compute it, you can read it and you're not going to get intimidated when somebody throws. In fact, you can ask them the question that essentially are going to kind of push them on whether they understand what the return on capital is. If you're a number cruncher, And this is the tougher task, let go of that need to check whether your answer is right. I mean, it's just deeply inbuilt. You feel that urge out. Did I get the right answer? It takes work. It takes work of saying, I'm wrong and I'm okay being wrong. It's psychological as much as, So I'm going to finish off. I'm not great with advice, ultimately 40 years, I've seen fundamentals go out of style, come back into style, go out of style. It always goes back to cash flows, growth, and risk. And it's not something I invented. It's been around for as long as people have been. Second, it's so easy to get caught up in the little details here, when in fact it's a big picture. So as you value companies, step back and look at that big picture, what's driving the value. Third, go out there, you're going to have people say, I've been in this business 30 years. Let me tell you what I've learned. Just walk out of the room, because this is a business where being around 30 years gives you almost no learning curve in this. He'll tell you anecdotal evidence. I did this in 1998 and it paid off for me. Qualitative statistics with a sample size of 1, don't build castles on top of it. And keep your perspective. It's only a valuation. I remember about 10 years ago, somebody at the end of this class comes up. She was a history major from Yale who came back for an MBA. And usually when you come back for an MBA as a history major, you take all the classes with the word strategic in their name. You can go through 2 years of the MBA program without ever seeing a number. I wish I'd known that. So she comes to me at the end of the class. She says, I never thought this would happen, but I have a job as a sell-side equity research analyst. I said, my condolences. No, I said, congratulations. Yeah. And she said, I'm really scared. And I said, what are you so scared about? She said, what if I make a mistake? I said, be glad you're not a brain surgeon. Brain surgeon makes a mistake. Somebody dies on the table. You make a mistake, what's the worst that's going to happen? Somebody gets a little richer. Somebody else gets a little poorer. Just make sure that somebody who's getting a little poorer is not you. Think like a Marxist. You move some wealth around. The world has intended. Move on. There's nothing in valuation you should be losing sleep over. And finally, if you're given a choice between knowing everything there is to know about valuation and being lucky, which one should you pick? Luck is the dominant paradigm. I'd love to tell you skill, but this is not like NBA basketball. You can't make 10 3-pointers from luck, but you can have 10 good years as an investor. Brought home to me by my mother-in-law when she came to visit. I think it was 2000, peak of the dot-com boom. She would drive us crazy all day long. She would talk about what was in her portfolio, what was out of her portfolio. And I had to act like I was listening. That's what son-in-laws do. And then she let it slip that she owned Qualcomm, one of the great stocks of 1999. So I said, Judy, why did you pick Qualcomm? I don't know why I ask her these questions, because she always tells me. She said she bought Qualcomm because it owned MCI. I said, that's not Qualcomm, that's WorldCom. She said, Qualcomm, WorldCom, what's the difference? I said, you bought the wrong company. If you bought WorldCom, the stock that owns MCI, you'd have lost money. So you buy a stock that rhymes with it and you make 500%. After she left, I did try a strategy out, pick a stock in the news, pick one that rhymes with it. You know what? If I'd made a lot of money, this entire class would have been the rhyming stock. Every week would have come and these stocks rhyme, pick this one if this one gets in the news. So be lucky. So if you're superstitious, stay superstitious. If you find your stocks going up because you buy that venti cappuccino from the same Starbucks, fly 3,000 miles if need to be to get to that Starbucks and get that cappuccino. Luck is the dominant paradigm. Finally, don't forget to do your CFEs. And this is purely selfish on my part, because you know what happens when MBAs and the undergraduates have no restraints. But if you don't do your CFE, what can you not check? You can't check your grade. When you can't find your grade, guess what happens next? You will email me. I'll be on the beach in San Diego and say, what is my grade? I can't check it online. I don't want those emails. So just do the damn CFE when you get a chance. I think it opens tomorrow. So just get it done and get it out of the way. Thank you very much. And good luck on your graduation. The real estate.
Why?